to the chapter on cost of capital. It's a two-session series. This is the first session. In this session, we are going to cover three learning goals. We're going to look at the basic concept of and sources of capital associated with the cost of capital. Basically, this is related to the debt component and the equity component. Then we are going to explain what is meant by the marginal cost of capital. And finally, we're going to look at how to determine the cost of long-term debt, explain why the after-tax cost of debt is the relevant cost of debt. Let's begin. The cost of capital represents the firm's cost of financing and is the minimum rate of return that a project must earn to increase firm value. So it is pretty obvious that whenever a firm is going to invest or select a project, the project must add certain value. Now this value has to be greater than what the value firm already creates. So this is the firm cost of capital, or the firm cost of or the rate of return is the minimum that the project must earn. So let's say firm is earning an weighted average cost of capital of 7%, and the project is bringing return of 5%, then the firm is not getting any benefit. In fact, the firm's own return will be diluted by the project. So this is important to understand, that the return of the project, if it is, let's say, 8%, then and only then, or more than 7%, in that case, the project will be able to create value for the firm. So it will increase the rate of return of the firm. So financial managers are ethically bound to only invest in projects that they expect to exceed the cost of capital. The cost of capital reflects the entirety of the firm's financing activities, and we do not look at only just the debt component or the equity component. It's both ways. Now, most firms attempt to maintain an optimal mix of debt and equity financing. To capture all of the relevant financing cost, assume some desired mix of financing. We need to look at the overall cost of capital rather than just cost of any single source of financing. Let's look at this example. A firm is currently faced with two investment opportunities, investment A and B. Within investment A, there is a project. Let's call it P1. And then there is the least costly source of financing. So the project, if invest in project, the project will earn 7%. Or we can put that money into and invest in bond and earn 6% through debt. Because the firm can earn 7% on the investment of funds costing only 6%, so because market is willing to pay 6% for the same funds. However, the project is giving us a percent higher than that, hence the analyst would recommend that the firm undertake the investment. In investment B, the same cost and the life. However, the project 2 is giving an expected return of 12%. While the least costly source of financing right now available, where the firm can invest its money or it can take up that project, is it costs 14%. Now, in this instance, the analyst recommends that the firm reject the opportunity because the 14% financing cost is greater than 12%. You can see that 14% is greater than 12%. So this is what we are going to earn if we invest, and this is what the market will pay if we invest in this. So if we invest in 14%, maybe certain stocks of another firm, we buy that and it pays us 14% return, then it's better to invest in it rather than invest in a new project which is cost $100,000, life is 20 years, and it only gives us 12% return. So the benchmark is with the least costly source of financing. Whenever we accept a project based on least costly source of financing. So this is basically debt, and this is basically the investment B is related to equity. And how do we know this? Because in investment A, we were matching or benchmarking against the debt, and in investment B we were benchmarking the project acceptance against the investment in equity. Now what if the firms used a combined cost of capital? Now let's assume firm has these two components, debt and equity. So firms invest 50% in debt and 50% in equity. Now in this case, we can have a minimum rate of return, an average. We can calculate that what will be the average return. So in this case, we can simply uh, take the debt, which was 6%. So 0.5 multiplied by 6% debt. If you remember, this was the debt, and then we have adding the other one, which is 0.5 multiplied by the 14% equity. This gives us a 10% average cost of capital. So it is the average cost of capital. Now this is a new threshold. So if we are maintaining debt and equity in the firm, our threshold of minimum return should be 10%. Anything above than 10% should be acceptable. Anything less than 10% should be rejected. So in this case, if you remember from the last slide, we have 7% in case of the investment A. So I'll write A, and investment B was offering 12% expected rate of return. Now in investment A, we were choosing 7% at that time because we were benchmarking against only debt component. But when we combine it with the equity component, our average threshold rate is 10%. So anything greater than 10% should be acceptable. This is not the case with investment A. So we will reject the investment A, which because 7% is less than 10%. Now in investment B case, we can see that 12%, which was previously rejected, now makes more sense, because in this case debt plus equity equals an average rate of 10%, and since 12% is greater than 10%, we should accept an investment B. So it is the combined cost of financing that matters, and not the independent modules or independent components of the capital structure. This is how it looks like, the sources of long-term capital. It will be either from the long-term debt, or it can be from the stockholders' equity. And stockholder equity has two components, preferred stock and common stock. So we will need, what is the cost of long-term debt? What is the cost of stockholder equity in terms of preferred stock and the common stock cost? So first we need to know how to calculate these costs, what are these costs, and how we can combine them together to find the weighted average cost of capital. So let's begin. Few of the definitions. For instance, the cost of long-term debt requires us to know about the flotation cost, specifically flotation cost. We'll begin from the pre-tax cost of debt, which is the financing cost associated with the new funds through long-term borrowing. So one has to remember that whenever we are calculating cost of debt, which is represented with RD, it has to be measured not on historical basis. It should not be historical basis, but rather current values. So what is the current value of the cost of debt? And we'll see there are ways to calculate it. Then we have to look at the net proceeds, are the funds actually received by the firm from the sale of activity of a security. So for instance, as a firm, I issue a bond which has a face value of $1,000, but I'm able to sell it only for $960, then I will receive $960. If I sell 1 million shares, then I'll get the total amount. So each bond is worth 960, and multiply by the million, you will get the rest of the amount. Flotation cost. These are the total cost of issuing and selling a security. So it's issuing and selling costs basically. So flotation are the issuing and the cost associated with issuing and selling. So issuing means there are costs related to underwriting costs and administrative costs. Underwriting, the word underwriting actually will be much more used later. So this is the cost or compensation earned by investment bankers for selling the security. So underwriting costs, any investment bank, first the firm has to go to first the firm has to hire an investment bank or a group of investment bankers to sell the bonds to the public. And in doing so, the investment banker are going to charge certain fee. That is what we call compensation. Also, they are going to take certain risk for the price that they are selling at. Hence, they will be compensated for that risk as well. Next, we have administrative costs. Issuer expenses such as legal, accounting, and printing costs. These costs are natural to all the issues, whether debt or equity. So let's look at an example. DC, a major sanitary manufacturer, is contemplating selling 10 million worth of 20 years 9% coupon bonds with a par value of $1,000. Because current market interest rates are greater than 9%, the firm must sell the bond at 980. So now we have, if the flotation costs are 2% or $20, then what is the net proceed? And the net proceeds is just subtracting the price that the price or the cash per bond that the company or the firm will receive minus $20. That is the flotation cost, and this is the 2% of the face value of the bond. Now, the before tax cost of debt, RD, is simply the rate of return the firm must pay on new borrowing. We already discussed. Now let's go into a little bit more detail. So RD can be, the before tax cost of debt can be calculated in any of one of the three ways. One is using market quotation. These are simply to observe the yield to maturity on the firm's existing bond or bonds of similar risk issued by other companies. The two that we are more interested in is the calculating the cost. Find the before tax cost of debt by calculating the YTM generated by the bond cash flow. This is possible if the firm has already a bond in the market. This is also possible if the firm can be mapped or matched in its risk return profile to another firm, and the other firm has the bond in the market, and we can calculate the YTM of that firm and apply on the on its old firm. Then we can also use approximation of the cost. This is the faster method than the calculation of cost. However, it's it comes with a little loss of decimals, and hence should be used cautiously. So these are the cash flows associated with the sale of a DC bond issue. So 960 is the cash that they receive. In the future, they will be paying $1,000, and 90 is the cash flows. So it comes out to be something like this on the timeline if we plot it. So it's 960 is what they will receive now, and they are supposed to pay. The firm supposed to pay. So I'll put it here: 90, 90, 90, and so on. So it's 1, 2, 20. So the last one going to, and there is another last cash flow which is also at 20 time period, which is the 1,000. So this is the face value, this is the price of the bond, and these are the coupon payments. Now, if the bond is in the market, then all we need to calculate the RD or YTM. It's also called the internal rate of return of the bond. So in order to calculate, I wanted to use an old method that we have studied in time value of money so as to refresh it, and that is also possible. You can use the bond valuation as well, and all of these methods are the same. So let's look at it. If I have to calculate the value of the bond using the annuity, so annuity will be cash flow divided by R1 minus 1. So I'll put the D for the debt, and this is N. And then we have plus a present value of the face value. So this is the principal amount divided by the 1 plus RD. This is it. So so we can put all the values. This is 960. This is what we have received, the value of the bond, and cash flow is 90 over RD, and then we have 1 minus, and this is 20 plus principal amount over 1 plus 20. So you have to pick different values for RD and to see that what value actually restore this equality. So both right hand side and left hand side has to be equal. If you start with 10%, it will give you a value of around 914. If you go to the 9%, it will be exactly coupon payment. So 9%, if you use 9% as the RD, so it's basically equal to coupon payment, and it will be exactly 1000. So in order to find out, it's appropriate that you can use the calculator, and here is it, which gives us the value of 9.54. So your input is 960 as the present value, future value is 1000, the NVT is 90, N is 20, you compute I and you will get 9.452. This is now the RD, or the cost of debt for the bond. However, cost of debt is not independent of taxes. Cost of debt, so debt by law is tax deductible, and hence that will be also sorted out a little bit later. So cost of long-term debt in terms of approximating the cost, and this is a method that is the same as RD. However, it actually helps us calculate a bit more faster than this. So it's basically the coupon payment or interest rate plus the face value $1000 minus net proceed, whatever we have received, and then we have the N. So this is what we have, and then we have to divide it by ND. So net proceed from the debt, ND, and this comes out to be plus $1000 divided by 2. This is the function that you use in order to calculate the RD fastly. You will see there will be a loss of few decimal points, but it's much faster than using the calculator. And what are the values here? So let me use it for the same again. So it is basically RD equals to I dollar face value, and this comes out to be minus 90 divided by N, number of time periods, and then this is ND plus 1000 divided by 2, and if I replace it with the values, that will give me 90, if you remember the coupon payment, plus now we have $1000 minus the net proceed from the debt was 960, which was the value of the bond, divided by the 20 years, and then you can have 960 plus $1000, and this gives us, so this is the and this gives us basically $90 plus $2 divided by $980, and the answer comes out to be 9.3888%. Now this amount is the previously we calculated it was from the YTM method, and that comes out to be 9.452. And you can see there is some differences in the percentage, 9.452. Otherwise, it's the faster method, and it can be used even without the calculator or with a simple calculator. So that's the prime benefit of approximating the cost. Now the interest paid to bondholders are tax deductible for the firm. So the interest expense on debt reduces the firm's taxable income and therefore the firm's tax liability. This is what we know, and hence this has to be incorporated into cost of debt. So the cost of debt becomes RD 1 minus T. So this is after tax cost of debt that is relevant. So DC has a 40% tax rate using 9.452 before tax. Find after tax cost of. So this will be pretty simple. It's 9.452% multiplied by 1 minus 40%. That comes out to be 5.67%. But typically the cost of long-term debt for a given firm is less than the cost of preferred or common stock, and this is partly because of the tax deductibility of interest. So in this session we have covered three learning goals. One, the basic concept of sources of capital associated with the cost of capital. We also look at the marginal cost of capital, which is the average cost of capital, and then we have also looked at the cost of long-term debt and explain why the after-tax cost of debt is the relevant cost of debt. Thank you.